Well, so again, one of the psychological challenges of running focus investing is knowing when the market goes against you, distinguishing this, I am wrong, or the
Yeah,
market is wrong, or my
yeah,
advisor is wrong.
yeah.
So how do you make that distinction? And how do you think that Warren makes that distinction versus others that perhaps don't do it as well?
Well, Warren has spoken about this, and he quotes his mentor, his teacher, Ben Graham, who said, you're neither right or wrong because the crowd agrees or disagrees with you. You're right based upon your facts. And so Warren introduced a concept in the early 1990s called look-through earnings, and basically said, look, just because it's a publicly traded security, I am judging the progress of my business, whether it's Coca-Cola, American Express, whoever it is, based upon their economic returns. How did we do? And he focuses a lot on return on equity. How's the return on equity? Are we growing earnings? How are margins and stuff like that? So he's measuring his progress of publicly traded securities, public stocks, by the same measuring stick that he's using for his private businesses, because he sees them as one and the same. And ultimately, as Graham says, in the short run, the market's a voting machine. In the long run, it's a weighing machine. It's the economic weights at the end that will ultimately determine the stock price. They do meet up. I mean, they bounce around, but the correlations over 5 years, 7 years are really quite strong. And so what you have to do when the market is moving against you and you hold a compounder, by compounder, it's a company that earns a high rate of return on capital and can reinvest money back into itself so it continues to compound. And when the market moves against you and the price is not in your favor, although you could argue a lower price it is in your favor because it gives you a chance to buy more stock. What we're doing is just reporting the economics of what we own. So we have what's called an economic benchmark in our portfolio. We have a weighted average, return on equity, have a weighted average owner earnings cash flow yield. We have a weighted average growth in sales. We have a weighted average on how our earnings are doing. And so we're just looking at as if it's a private equity portfolio.
Right.
We're making good progress economically speaking. The price is going to be fine. We'll get there. And so that's how we do it when the market moves against us. And so our job as advisors, portfolio managers to our clients is to continually communicate to them our economic progress. And if they understand the economic progress, or at least appreciate we're making progress in our economics, it takes the sting out of when you're not beating the market or you're out of favor with the market.